Welcome everyone to another in our continuing series of trade and adjacent area webinars. Very excited to be with you today. I'm Nate Boland. I'm a partner with the law firm of K&L Gates here in Washington, D.C. And I'm very, very pleased to be joined by my good colleague, Mary Baker, who is going to talk to you about all things tax. We have an exciting set of developments that have happened this year. I'm sure that many of you are aware. There's a lot to talk about and a lot of both opportunities and things to watch out for, and opportunities for engagement that come out of this legislation and how it will be implemented. So Mary is here to talk to all of that. Just one thing as a plug for future webinars before we really get started here. There's a lot going on also in the trade and tariff world, including announcements earlier today about potential tariffs on India starting on August 1. We're going to be having a series of webinars that talk about that coming up, including one tentatively targeted for August 13th. We'll be sure to get around details on that soon. But a key part of this administration's agenda is the tax legislation, which is now law. And Mary is the best person I can think of to talk about that. She has a stellar career, having been with the Senate Finance Committee, as well as with the IRS and in private practice here as an advisor to companies large and small on tax issues. She's been following this extremely closely to the point where I've been getting, particularly as the legislation was moving through Congress, sometimes hourly updates on what's happening. So Mary, really thank you for joining us, and I'll turn it over to you to kick us off.
Well, thank you so much, Nate, and good morning, good afternoon, everybody. Thank you for having me this afternoon. And so what I'm going to do is I will talk about the One Big Beautiful Bill Act that was signed into law by President Trump on July 4 against all odds. I think a lot of people never thought that they would get it done in time for him to have a July 4 signing, but they did. And so what I'm going to do is I will talk about some of the highlights, particularly as they pertain to businesses, and then I will be happy to entertain questions that you have. And just to kind of give you a sort of a structure of how I plan to talk about this, I'll talk a little bit about what's not in the bill, which some of the things are good, some of those things are bad, then talking about specific provisions that affect business operations, kind of an international update on changes to the international tax regime, and then opportunities for investment that are in the bill, and then other things in the bill that affect benefits to employees or G&A type of activities. A little bit on clean energy credits, because I know that some of you are in the supply chain for automotive, but perhaps for other energy components as well. And then looking ahead to what's next and what you should be expecting and how you can help to shape the future of how some of these provisions are implemented. So with that, what's not in the bill? First of all, there was not any increase in the corporate tax rate, which was good news. And also good news was a permanent lower individual tax rates. All of the 2017 Tax Cuts and Jobs Act individual tax rate cuts were made permanent. That was a big priority of President Trump and of Republicans, and they were able to make that happen. For those of you that might be large enough to be impacted by the corporate alternative minimum tax, it did not repeal the CAMT. There were some tweaks around the edges on things that could be excluded from the CAMT computation, but it still is in place. For those of you that are large enough, corporations that are large enough to be impacted, there was no increase in the stock buyback excise tax. There was discussion at one time of increasing that to as high as 4%, but it stayed at 1%. Importantly, in kind of going over into Nate's realm, there was no Section 899 revenge tax that was included in the final bill. And so the revenge tax would have increased the tax rate on any foreign corporation with US effectively connected income, or foreign individuals with certain types of income. It could have increased their rate on their US income by as much as 20%. And where that also would have had a big impact is if you are a foreign headquartered company and a U.S. subsidiary, and you are paying dividends to your foreign parent, that those dividends also would have been impacted by this 899 revenge tax. That was taken out at the last minute. It was primarily in there, I think, for leverage to try to get better trade deals, and also to help convince the OECD that the United States will be in compliance with the Pillar 2 under tax profits rule. So it is out for now. It is not, these proposals never completely go away, and it's sort of hanging like the sword of Damocles over people's heads that it could come back. But for now, it is not in play. Moving on to business operations and changes that particularly affect how businesses operate, or opportunities for deductions and that sort of thing. The 199 Cap A pass-through deduction was made permanent. That was also a Tax Cuts and Jobs Act provision that was temporary when it was initially passed, so that was made permanent. There was a proposal at one time to raise that deduction from 20% to 21%, but they couldn't afford to do that, so it just stayed at 20%, but it was made permanent. There's already discussion of another budget reconciliation bill this fall. I think most are skeptical that Republicans will be able to pull it off, but to increase that 199 Cap A deduction from 20% to something larger, I've already heard Chairman Smith of the Ways and Means Committee talk about that he'd like to increase that rate. His focus is on smaller businesses, family farms, and so that's right in his wheelhouse that he would want to make that a larger deduction. It also made several 2017 Tax Cuts and Jobs Act provisions that were temporary permanent, including permanent full expensing of property and equipment for businesses. So that is now permanent. It also made permanent the research and experimentation expenses. Those beginning in 2022 had to start being amortized, and so it made that expensing permanent. And it added a new code section, and you can catch up. You can make a catch-up deduction for expenses that you unamortized expenses that are sort of dangling out there since 2022. So that is a very positive development to be able to deduct those costs fully in the year that they are incurred. It also permanently expanded the base to calculate your interest expense deduction from EBIT to EBITDA. That was the 2017 Tax Cuts and Jobs Act had an EBITDA base, but it went down to EBITDA or EBIT in 2022 because they had to do that to make the books balance in 2017. Now that base is the larger EBITDA tax base. And the bill also changed that computation to, or clarified that for purposes of your base, you can include both capitalized and non-capitalized interest. So that serves to make your base a little bit larger. It also includes something brand new, which has been tossed around for a while, but is extremely expensive, is a temporary full expensing for facilities that are used for manufacturing, production, and that's limited to ag and chemical production, and mining facilities. And so for facilities that begin construction before January 1 of 29 and that are placed in service before January 1 of 2031, you can deduct the full cost of those facilities. If you're familiar with the Section 48D investment tax credit for semiconductors, it's sort of like that. You can deduct the full cost of your facility, carving out your G&A office type of space, but the actual manufacturing, production, or mining space is fully deductible. So that is that's a big deal. There's some other things that are not necessarily beneficial. It did impose a 1% floor on corporate contributions. So when you're calculating your corporate contribution deduction, you have to take a haircut of the first 1% of your taxable income. And just incidentally, there was a 0.5% floor that's been imposed on individuals. Um, it there's the non-corporate business losses, which limits the amount of business losses that you can take. That limitation has been made permanent. Um, it also aggregates, it clarified that you need to aggregate entities for purposes of determining whether you have an excessive employee compensation deduction. So instead of taking it entity by entity, you now have to aggregate your related entities. Another good thing, if you are a smaller business, it increases your Section 179 full expensing deduction up to 2.5 million. And also, if you are a semiconductor facility, for semiconductor facilities, it increases that ITC up to 35% for 1 year, up from the 25%, which probably doesn't affect any of you. But then on international, there were quite a few changes. So if you are paying any sort of the GILTI, the Global Intangible Low Taxable Income, which now has been renamed to Net Controlled Foreign Corporation Tested Income. So if you pay GILTI, or if you also are able to take the old FDII, the Foreign Derived Intangible Income deduction, which now has been renamed Foreign Derived Deduction Eligible Income. I guess they didn't like the acronyms GILTI and FDII. Those tax rates were scheduled to, the effective tax rates were scheduled to go up. And they did go up, different from what they were scheduled for, but they are now permanent. They are not temporary, and the effective rate is now 14% for both GILTI income, which is CFC income, that you're taxed now at a rate of effective rate of 14%, and then on your sales of, if you have revenues from royalties or intangibles, that FDII rate deduction or permanent effective tax rate is now 14%. It did change a few things in the computation. The old computation for GILTI, for example, you were able to reduce your CFC income by roughly 10% of your capitalized costs of your CFC. It took away that deduction that's called the QBI deduction. So that has the impact of increasing effectively what your tax rate is. It did also allows you to take advantage of 90% of your foreign tax credit. Under the IRA, it was only 80%, so that is a benefit. So there's things going both ways on the old GILTI and FDII deductions, and I'll predict that people will still continue to call them GILTI and FDII because, one, they're kind of fun to say, and they're a lot easier to say than any acronym of the new names. The base erosion anti-abuse tax is now a 10.5% rate. It was 10%. So if you are making certain payments to a foreign parent, that rate is now 10.5%. There were a lot of other changes that were proposed at one time to be, particularly as part of the 899 revenge tax, but those did not come to pass. So they just increased the rate to 10.5%. And one of the reasons that they had to change these rates was not just because they needed to raise revenues, which was one of the reasons, but the other was that under the budget reconciliation process that Republicans used that only required a majority vote in the Senate, every provision has to have a budgetary impact. And so they had to fiddle with the rates in order for each of these to have a budgetary impact, or else the Senate parliamentarian would say, no, you can't include that in the bill. There was a change to sourcing rules for sales of US produced inventories. So more inventory will be treated as foreign source and not US source. So that's a benefit for calculating your foreign tax credit, for example. It made the CFC look-through rule permanent, so that is beneficial as well in terms of not being double taxed on certain income. And then this is really down in the weeds, but it is important if it's important to you, if it affects you, that it restored the limitation on the downward attribution rules to determine constructive ownership of foreign-owned entities in calculating whether or not you had constructive ownership. If a U.S. person had constructive ownership, it limits those downward attribution rules. So that means that fewer U.S. Entities are going to be considered to have constructive ownership. On the investment side, there were a couple of significant opportunities. If you were familiar with the 2017 opportunity zones, which provided a real benefit if you had capital gains to invest in an underserved community, you had to eventually pay tax on those capital gains, although that gain was deferred. But importantly, if you held on to that investment in that business located in an opportunity zone, if you held on to it for at least 10 years and then sold it, you did not have to pay any gain on any tax on the gains from the sale of that business. And so the opportunity zones were made permanent, and there is an extra bump for if you are investing in a rural area. So I would really encourage you, if you're not familiar with opportunity zones, to find out more about it. Because it is a fantastic opportunity if you're planning on making an investment in a business that's going to grow in value, and then you're planning on selling it someday, to not be taxed on the gains. That's a really big incentive, so it's worth checking into. And then for small businesses, you may be familiar with the qualified small business stock gain exclusion, that if you have a certain business that is has a limit to the amount of capital assets, and then you sell that you can exclude the gain, at least a portion of it. So it shortened the period that you can exclude some gains. So now if you hold on to a qualified small business for at least 3 years, you can exclude 50% of the gain if you sell it. If you hold on to it for 5 years, you can exclude 100% of the gain. So again, if you can take advantage of that, that can be a real benefit to you. On the benefits side, one of the things that's included, which was a big campaign proposal from President Trump, was no tax on overtime. And it went through various iterations, but it finally ended up that if you're a single taxpayer, you can exclude $12,500 of your overtime income. If you file a married filing joint return, you can exclude up to $25,000, and then that phases out at certain income thresholds. And that is available for tax years 2025 through 2028. And I know that employers have a lot of questions about, well, how does that work? And we're probably not going to know exactly how the IRS is going to expect you to implement that until we get some guidance. And the IRS has indicated they are working on guidance on this because it is effective in 2025. But you will be required, if you're paying overtime to employees, you will be required to file an information return, whether that's part of the W-2 or a separate information return, specifically identifying that you have paid X amount of overtime. And the IRS will put out new withholding tables at some point that you'll need to deal with. So their guidance is forthcoming, but there will be some administrative burden on you as the employer to implement that particular provision. They made the family and medical leave credit permanent. If you provide snacks for your employees on site, you cannot take a deduction for those snacks anymore. Those were ended. It increased the credit for employer-provided childcare to up to 40% or 50% for certain small businesses. The exclusion, if you are helping to pay your employees' student loans, that exclusion is now for your employees is now indexed from their income. And then the 1099 threshold that you might issue if you are buying property over 600, the old threshold used to be $600 would be the trigger that you had to file 1099. That finally got increased. It was increased to $2,000 and it is now indexed. Kind of wrapping up, moving on to clean energy credits. So all of the clean energy credits in the Inflation Reduction Act were touched in some way or another. Probably what is, if you are a behind the meter company where you are supplying your own, say, wind or solar to supply your energy needs, it did make significant changes to when you need to begin construction on those facilities to be able to qualify to take a tax credit. So if you are considering a behind the meter situation, you need to check out those dates. But if you are in the supply chain, importantly, if you're in the supply chain for anything to do with a clean energy facility or energy storage or the 45X credit, which is the production of wind components, solar components, inverters, battery modules, if you're in the supply chain, they are going to be subject to your customers will be subject to something called the prohibited foreign entity rules. So basically, if you are a Chinese company or controlled by a Chinese company or other, it's kind of a, China's sort of the poster child for that, but there are other prohibited foreign entities as well. If you're a PFE, you cannot qualify to take these credits for taxable years beginning after the law was enacted. But if you have customers who are buying your products, they will need to know from you what percentage of the product that you are selling was produced by a prohibited foreign entity. So you're going to need to know what's a prohibited foreign entity, and you're going to need to know where your components are coming from to produce your parts that you are selling to your customers. And those are called the material assistance cost ratio rules. And so it's basically a test of what percentage of the direct costs going into your product are attributable. I use the term that have a PFE DNA in them. Any taint, they were touched by a prohibited foreign entity. You will need to know that because there's a limitation on the percentage of those costs in products that can be from a prohibited foreign entity. It's complicated, and I was saying the other day, the more I read those rules, sometimes the less I feel like I know them because you're always uncovering some sort of detail. So it's really important to understand those rules. So last, what's next? President Trump issued an executive order on July 7, so he gave taxpayers who were kind of breathing a sigh of relief that their project was going to qualify, their clean energy project was going to qualify. He gave them 3 days and then issued an executive order, which is ripening on August 18, that may change the beginning of construction rules. And a lot of the clean energy credits are based on beginning of construction rules. So it could change those rules, and there could be projects that thought they were going to qualify that won't after they change those all-important beginning of construction rules. So right now there's a chill on a lot of projects because we're just waiting to see what that executive order says. We're also going to be seeing new regulatory projects on new proposals, new provisions in the OBBBA. And then we also expect that existing regs that have been finalized under the Biden administration, for example, on the clean energy credits, will be reopened. And once they're reopened to accommodate changes in this bill, they're all fair game. It's not like the things that the Biden administration finalized are just sort of sacred and can't be touched. Everything will be on the table for reconsideration as to whether or not they comply with this administration's priorities. We're also seeing that the IRS is pulling guidance that was issued before, or they are revising guidance that was issued before as a result of the Trump administration and the OBBBA. So we're going to continue to see that. We will also see sub-regulatory guidance, which does not require a notice and comment period. It just kind of appears one day on some of these proposals as well. And then it's also, I spent a lot of years, as Nate said, at the IRS. And so I'm very interested in how the IRS is going to implement and enforce these rules, and what, with IRS staffing cuts and just a new sheriff in town, exactly how what the IRS is going to focus on, and how they will go about enforcing that. And I want to stress that as these regulatory projects are announced, no company is too small to be able to have an impact. It's really important, if there's something in these in the law that is going to impact you and it's unclear how it's going to impact you, or if you fear that the rules may come out negatively, it's really important to engage and to provide comments, because the Treasury, I know a lot of the people over at Treasury that are going to be working on these rules, and they are thoughtful, credible tax people, and they're not just political people, and the input from stakeholders is going to carry weight in how they write these rules. The last thing I forgot to mention about 30D, which is the clean vehicle energy tax credit, and then we had the 45W commercial clean vehicle tax credit. Those both have been repealed, and so they are, which is no surprise, but I think that some of you are suppliers for the motor vehicle industry, so it's important just to mention that. So I just went through a big, long laundry list of things, but happy to answer questions. And if we can be of any help after the webinar to talk about some of these points, I'm happy to do that.
Well, thanks, Mary. I don't know of anybody else who could summarize this bill in that efficient and very clear and concise manner. So thank you. A number of questions that I'll maybe get us started with. If there are questions from our audience, please feel free to put those in the chat. We'll try to address them here. If you have questions afterwards, of course, our contact information is in the materials here, and feel free to reach out anytime. I think, Mary, one thing that I find as a non-tax person somewhat perplexing about any tax bill, and this one particularly, and that I do hear questions on fairly regularly, is, and I think you touched on some of this in your remarks, but I think somebody who's not steeped in tax would say, okay, Congress has passed this bill. There's got to be one single start date when these new provisions all take effect. But if I heard you correctly, there are many different start dates, and I'm hoping maybe you could help us unpack a little bit which are the operative dates. And maybe we would start with the example of a company that has heard a lot about the investment in manufacturing facilities, maybe even the whole building, as well as equipment, and being able to expense that. If they're in the midst of a capital upgrade project right now, and maybe have been earlier in 2025, are they eligible for that? Or is it better if they kind of put things on hold if they want to claim the credit and do all the expenditures in the subsequent tax year?
So on the full expensing, it's a very good question, because for what I call the Tax Cuts and Jobs Act trio, which is the full expensing, interest expense, and R&E expensing. For R&E and interest expense, those are effective at January 1 of 2025. But for full expensing, if you remember, President Trump, during his, it wasn't called the State of the Union, but his speech early this year, which was sort of in place of the State of the Union, he said that he wanted to restore full expensing on the day that he was inaugurated. So for full expensing, it has to apply to equipment that is acquired after January 19, because the inauguration date was January 20. So, there's no other reason other than there was just complying with what he said in that speech, that you have to acquire the property after January 19 of 2025. We expect that the rules will probably be similar to what they were when the Tax Cuts and Jobs Act passed in terms of what the binding contract rules, if you have a binding contract in place on January 20.
Mhm.
But the general rule is you have to acquire it during January 20 or after. And then on the manufacturing facilities, similarly, it's a date. You have to begin construction before 20, it has to be after, I believe it's after January 19, the same as the full expensing. So you'd have to begin construction on that facility based on whatever the beginning of construction rules are going to be after this executive order, whatever changes are made after January 19 of 2025, and then you would have to place it in service no later than the end of 2030. But you raise such a great point. Like even on the foreign entity of concern rules or the prohibited foreign entity rules, those all they're not consistent. And some of them apply, almost immediately. Others are delayed for as long as 4 years. And it's just that's why I say sometimes when I read this, the more I read it, I feel like the less I know because it makes you can't just paint a broad brushstroke and say, oh, well, it's generally this, because generally is a very dangerous assumption. You have to pay attention to the details.
No, that's really helpful and important points. I mean, I think given all that, there's a sense in the market, we get it from the trade side too, is a lot of companies are kind of holding their breath or holding off on pushing the button on go for projects. And it sounds like there's a similar dynamic going on from a tax perspective. The rules or guidance that you were mentioning about, for example, what would constitute acquiring equipment? Does that mean physical delivery? Does that mean signing a contract? Does that mean making a payment? Things like that. Are there going to be rules that are coming out soon? And do you have a sense of when that guidance or rulemaking would be taking place?
Treasury and the IRS have said that they're already working on some of the rules like that take effect in 2025, like the overtime rules that I mentioned, no tax on tips, that sort of thing. So to the extent that things are effective in 2025, I think those are prioritized, that they will try to get some kind of guidance out. Now, it probably won't be regulations at first. It could be a notice, which the IRS is fond of using. It could be something as simple as frequently asked questions, because the IRS also used those after the Inflation Reduction Act. And some of those, especially FAQs, are not the most reliable. They're sort of like, okay, let's slap together some common questions and we'll put the answers out there. But they have indicated that they recognize that there is an appetite, that there is a need to provide certainty so that companies really know what they're dealing with. So I think they will be trying to get things out as quickly as possible. But in Treasury lingo, soon could be anything from 2 weeks to 6 months from now.
Presumably, there's some kind of a reasonable reliance standard where if the FAQ comes out this year
Yeah,
and then later on, subject to slight modification, you're not going to be necessarily penalized if you relied
that's
on
right.
the
That's right.
FAQ. Okay.
Yes, they do say on their website generally when they post facts that FAQs that they may, if it turns out that they were incorrect, or if they change their mind, you still would owe the tax, but they will not impose a penalty on you.
Gotcha. A related question that I've heard a fair amount, and this comes up especially from companies that are kind of in startup or maybe greenfield expansion mode, is okay, we hear or we get that there's going to be full expensing for capital investments, maybe facilities, depending on what we're doing. But what if we're not generating taxable income for a few years? How is that going to work? And that may be a question that requires some further guidance from the IRS, or it's talk to your accountant kind of thing. But just curious if you have a sense of that, because I think that's one thing that I've heard people say, well, that sounds really good, but I'm not expecting to make a lot of taxable income for a while. We're going to be in startup mode. doing
Mhm.
investments.
And I don't remember if on the facilities, if it's an election, but for full expensing, at least last time around, it was an election. I would have to go back and read the statute to make sure, but yeah, last time on full expensing, it was an election. You did not have to take full expensing because, to your point, if you have losses, it really doesn't do you any good.
And I think that's a conundrum some companies will be facing as they're looking at and hearing the message about the administration wants reshoring, rebuilding. There are tax credits available or tax, full expensing, et cetera. But then there's the sort of present tense business condition of, well, we may not see any benefit from that if we're not in a position where we have a profit
Mhm.
at the end of the year. So that will be an interesting one to watch. Many interesting aspects of this to watch. Um, you had mentioned, and I think for some of the companies in AGMA and ABMA, this is particularly important, some of the changes to the Inflation Reduction Act and energy or renewable energy related tax incentives. Um, do you have a sense of when that whole process is likely to kind of conclude with the changes and the outcomes from the executive order and maybe more again to the theme of when are we going to expect to see certainty on some of this? Any sense of the timing for that?
The executive order requires Secretary Bessent, the Treasury Secretary, to take action no later than 45 days from the date of enactment. So that's August 18. So I am planning on taking some vacation time right around that time. So I'm pretty sure that's when it's going to come out.
Of course.
And I do expect that that's probably going to be in the form of an IRS notice and may not be. There's a lot of things that are dialable in old IRS notices on beginning of construction that they could change. And so it may not even be that complicated of a thing. They may change, for example, the beginning of construction safe harbor of 5%, they may increase that to 10%. That doesn't take a lot of time or work. So it's possible that the guidance could come out sooner than August 18, but it also, in addition to beginning of construction, the executive order also told the secretary to start dealing with some of these really complicated foreign entity of concern rules, the prohibited foreign entities and the material assistance cost ratio. That's complicated stuff. So whether we see one notice or whether we see one notice on beginning of construction and another on FIAC, I think that remains to be seen. But I'm confident because this president told the secretary, you will do something within 45 days. I'm very confident we will see something within 45 days. And on the other things, Treasury is still staffing up on some of the staff that is going to be working on all this. And I mean, it's just a monumental task too, because there's so many threads of all of these different provisions. It's not just touching one provision. It's like for each one, there's probably, a minimum of 5 other code sections that have to be addressed. It takes time. But so the first step would be if it is regulations that they would have to issue a notice that they're going to be working on regulations and invite comments from stakeholders. And usually that's a minimum 60-day period. And then they go to work and they write their proposed regulations and then they put those out. And then there's another comment period, public comment period. So all of that before things are finalized can take, I mean, sometimes it takes years and years, but if they're trying to get things out, 18 months is a pretty short turnaround time.
Yeah. No, the number of moving parts and the amount of time that's required to get to some certainty on this, it just certainly mind-boggling. Yeah. Another sticking with the foreign entity of concern question, I know this can come up for some in the industries where they've got a supply chain that stretches back well beyond sort of where they have visibility to, for example, potential sources of minerals or components to, for example, maybe tungsten going into particular alloy product that then is going to be further machined and turned into a gear or something like that. Do you have a sense of where the administration and IRS are going on, how far back companies need to know their supply chain in this space?
I think it goes all the way up the food chain. I think that's probably where it's going to come out because, I mean, this is very much an anti-China type of measure. So if there's, they want to make sure if there's any DNA in there from China that they have identified it. And the one reason I think that it's probably going to be the way that they implement it. So in the legislation, in order to determine the material assistance cost ratio, it directs the Secretary of Treasury to issue a safe harbor guidance no later than December of 2026. But in the meantime, taxpayers can use an IRS notice that was initially put out to determine whether or not you qualify for the domestic content tax credit, bonus tax credit. And so taxpayers can use that. In addition to, they must also have a certification from their supplier that any inputs that are going into whatever the taxpayer is making, the percentage of prohibited foreign entity DNA that is in those parts. So I think it just, that goes all the way up through the food chain, is that if I'm buying from you, you've got to certify to me what percentage of what I'm buying is PFE tainted. And that supplier that's buying something from their supplier has to get a certification from their supplier of the PFE DNA. So I think it cascades up the food chain and to go all the way back to the initial source, because there are very stringent onerous penalties in the law as well. If you violate the material assistance, if you say that you've met the material assistance cost ratio percentages and you don't, there's a penalty not only on you as the taxpayer claiming the credit, there's also a penalty on the supplier that is giving you that certification. Now, how the IRS really enforces that if you have a foreign supplier, I'm not quite sure, but there is a penalty.
Interesting. Yeah, a lot of potential pitfalls for anybody trying to navigate that course.
Yes.
Yeah, maybe one last question, well, actually two last questions. So, going back to the expensing of capital expenditures, I think another question that we hear sometimes is, well, we're eager to do a capital investment. The only source for the machinery that we need for our factory is from outside the United States. We're going to have to pay a tariff on that. Can we expense the full landed delivered cost of that machinery, including the tariff that's levied on that? And that may be too early to answer that question because we don't have all the guidance, but curious in your thoughts on that.
Yeah, I think that the right answer is that, normally transportation costs are included in the basis. If you're capitalizing something or determining what your cost is in an asset, your transportation costs are included in that. I know tariffs are not transportation costs, but I think it's kind of like it travels. It is part of the attached cost of that for you to be able to acquire that. So I think that technically the right answer is that tariffs should be included in those costs. But I don't, like you say, it's hard to say how the administration will view that, and they may take a different approach. But I think that the right answer is that tariffs should be deductible.
So one last question for you before I let you go. I know you have a busy day coming up as well. Um, the There are a lot of moving pieces to this. You've already indicated there are a number of key guidance documents or FAQs yet to be released. Do you have recommendations for companies on how they can keep up to speed on this? I know certainly you, as part of your practice, offer some updates on a fairly regular basis, and I know you would be glad to speak with folks who are interested. But do you have just some sort of general tips on what to watch out for? What should I put on my calendar? What dates to circle? Who should I be talking to? And going back to one of your earlier points, if you have a position on certain issues for which the IRS and Treasury have yet to issue guidance. Is there a recommended way to try to engage to have some influence on that decision?
Yeah, so there, I mean, you can, um, probably the best way to keep track so that something doesn't fall through the cracks is to, like you say, I put out updates and I always flag when there's regulatory projects that have been announced. You can subscribe to Department of Treasury. They will put out releases and if you're diligent in following those, then that will flag if there's regulatory projects open, or you can go to regulations.gov as another source and you can check that. But it's easier if you know someone is looking out for all these things and you're not going to miss something. But that's and when the IRS is working on a notice, for example, there's not going to be a public announcement that they're working on this notice. And again, it's important to have good counsel that has those connections and those lines of communication that can give you a heads up that something is going on. And just because Treasury or IRS might be working on something that is not a regulatory project that doesn't have a statutory requirement to invite public comment, you can still, if you know that it's going on, if they're working on an issue, you can still provide input to Treasury and the IRS. But again, it's not really a public notice sort of a thing. So it's important to have good counsel to keep an eye on that. Once you know that there has been a regulatory project announced and comments are being solicited by Treasury, there's really no prescribed format for a comment letter, but there are ways that you can write a more effective comment letter and ways that are not so effective. And while you can write your own letter, and I admit that I'm biased because I write a lot of these letters on behalf of clients, but I think it's worth the candle, as they say, to have good counsel to write the letters or to assist you in writing the letters, because there are certain formats of writing letters, certain information that's important to be able to communicate to Treasury, certain things that are going to resonate, particularly with this administration. And to be able to push those buttons and to be able to try to feed them the information that is going to provide a persuasive argument for whatever your position is really important. And I've seen situations where maybe it's a smaller company, but it's a really important issue. It's like that they hadn't thought about before, but they needed to think about. And just that one letter from a small company has helped them to address an issue or to take a certain position on an issue that they might not otherwise have taken. And if they don't know about an issue, they can't address it. So if you have something you say, man, I really wish I knew what Treasury thought about this or how the IRS is going to enforce it, if it's sort of an arcane little issue that they're not going to have heard about, they can't address it. So that's another reason why it's really important to provide input, to flag these issues, and to provide suggestions and information to Treasury that will give them the ammunition that they need to substantiate why they would take a certain position and guidance.
Great advice, and I think that's a great way to wrap up today. I really appreciate it, Mary, for all your insights and very, very helpful overview and guidance, and getting down in the weeds here on a lot of this. It really matters to companies in these industries. Thank you, everyone, for joining us today. If you do have follow-on questions, you mull this over and want to reach out, we'd love to hear from you. And do look out for some announcements on our upcoming programs, including a real update on all the latest developments on trade and tariffs coming up very soon, targeting right now August 13th, and we'll be back in touch again soon. Thank you once again, Mary. Thank you, everyone, and hope you all have a good rest of your day.